Every April, you hand over 3 to 4 months of your life to the government. Not metaphorically, literally. You worked weekends, you skipped dinners, you showed up when you didn't want to. And when tax season hits, a massive chunk of it just gone, vanished before you could even spend it. Now sit with this for a second. A billionaire, someone whose name you recognize, whose lifestyle you've seen plastered across the internet, legally reported almost zero income last year. No shady offshore accounts, no illegal loopholes, no team of criminals in a back room. The IRS looked at his return and said, "Looks good." And here's the part that should stop you cold. He's not cheating the system. He's using it exactly as designed. And the same system that's quietly draining you dry? It has a completely different set of rules for people who know where to look. By the end of this video, you'll know those rules. You'll understand the exact 3-step strategy the ultra-wealthy use to build fortunes while paying almost nothing. And more importantly, how you can start applying the same principles today, even without millions behind you. Let's start with something nobody tells you in school. The way you get paid is engineered to be taxed. The moment your paycheck hits your account, it's already been cut apart. Federal, state, Social Security, Medicare. By the time it lands in your hands, you might be keeping 60 cents on the dollar, if you're lucky. This is called earned income. And it is the single most aggressively taxed category of money in the entire U.S. tax code. Taxed first, taxed hardest, taxed every single year without exception. Now here's where the wealthy quietly made a different decision. They stopped trying to earn more income. They started buying assets instead. And this one shift, this single mindset change, is where the whole game flips. Phase 1. Buy. Instead of grinding for a bigger paycheck, they take their money and funnel it into things that grow. Stocks, real estate, private businesses. But here's the critical piece most people walk right past. When those assets increase in value, you owe zero in taxes, not less, zero. This is called an unrealized gain. And to the IRS, it simply does not exist yet. So picture this. You buy something for $100. Over a decade, it climbs to $5,000. You've made $4,900 in real, actual profit. And your tax bill? Nothing, because you didn't sell. Compare that to your salary. Taxed immediately, every year, no matter what. You start to see how wide this gap really is. This is exactly why you see billionaires gaining billions in a single year, while showing almost nothing on their tax returns. The wealth is real, the growth is absolutely real. But because it lives inside assets they haven't sold, the IRS legally cannot touch it. Now you're probably thinking, okay, but if everything's tied up in assets, how do they actually pay for anything? Good, because this is where it gets genuinely interesting. Phase 2. Borrow. This is the part that breaks most people's brains, because it goes against everything we were taught. Debt is bad, right? Debt is dangerous. Debt is something you eliminate as fast as possible. For most types of debt, that's absolutely true. But the wealthy use debt in a completely different way. Instead of selling their assets, which would instantly trigger a massive tax bill, they borrow against them. They walk into a private bank, use their portfolio as collateral, and take out a loan. It's called a securities-backed line of credit. And it's one of the quietest wealth tools in existence. Here's the part that changes everything. Loan proceeds are not income. When a bank wires millions into their account, the IRS sees nothing. No income, no taxable event, just liquidity, completely tax-free. They use that money to fund their lifestyle, make new investments, travel, spend, all without selling a single share or triggering a single dollar of capital gains tax. But what about the interest, you ask? Here's where the math turns in their favor. If their assets are growing at 8 to 10% annually, and their loan costs 3 to 4% in interest, they are still ahead. They're making money on borrowed money while their actual wealth keeps compounding in the background, untouched. This is called positive arbitrage. And it's the polar opposite of what most people do, which is sell assets, pay the tax, shrink the portfolio, then wonder why building wealth feels so slow. But here's the thing. Even this isn't the most powerful part, because the final phase is where this strategy becomes truly generational. Phase 3. Die. Dark? Yes. Powerful? Absolutely. After years of buying and borrowing, never selling, never paying capital gains, the question eventually becomes what happens to all that debt? And this is where the strategy closes in the most elegant way possible. When appreciated assets are passed to heirs after death, U.S. tax law triggers something called a step-up in basis. In simple terms, the entire tax history of that asset resets to zero. An asset bought for $1 million and grown to $10 million? If the owner had sold it during their lifetime, that's $9 million in taxable gains, potentially millions owed to the IRS. But when it's inherited, the new cost basis becomes $10 million. All of that accumulated decades-long gain, legally erased, gone. As if the growth never happened. The heirs sell a small portion, pay off the outstanding loans, and keep the rest, with little to no tax impact. And the cycle begins again for the next generation. Buy, borrow, die, repeat. This is not a glitch. It's not a workaround. It is the tax code functioning exactly as written, rewarding those who build assets and penalizing those who simply show up and earn a wage. Now, here's what most videos on this topic quietly skip over. You don't need to be a billionaire to start thinking this way. Let's be honest, you're not walking into a private bank tomorrow and borrowing $5 million against your stock portfolio. At its full scale, this strategy is used by people with $30 million or more in investable assets. That's a tiny fraction of the world's population. But the principles underneath it? Available to you right now. Here's how you start. First, rethink low-interest debt. If your mortgage is at 3% and the market has historically returned 8 to 10%, every extra dollar you throw at that mortgage is a dollar that stopped compounding. The wealthy don't rush to eliminate cheap debt, they redeploy it. Second, look at your home differently. As your equity builds, a home equity line of credit gives you access to capital without selling anything. You can use that capital to invest further. That is your entry-level version of borrow against assets. Third, and this one is critical, build a taxable brokerage account, not just retirement accounts. Because retirement accounts come with government restrictions. A taxable brokerage account is where this strategy actually lives, where flexibility actually exists. Start simple, index funds, buy consistently, hold. And when you eventually need cash, learn how to access it without selling. That's the shift. Here's the bottom line. Every year you spend focused only on your paycheck, you're playing by the most expensive rulebook in the system. Because these rules aren't random. They're intentional incentives. Build assets, you're rewarded. Build businesses, you're rewarded. Earn a salary alone, you're taxed the hardest. The wealthy didn't just outwork everyone. They opted into a different set of rules entirely. And now you know those rules. So the only real question left is, what are you going to do with them? Start today. Open a brokerage account if you haven't. Put in whatever you can. Buy a simple index fund. And make one commitment to yourself. Don't sell. That's step 1. That's where it begins. And if you're ready to go deeper, the exact accounts, the specific strategies, and the concrete moves you can make this week, the next video breaks all of it down. Watch it right after this, because the system isn't changing anytime soon, but you absolutely can.